My name is Brooke Baczynski. I am the Manager of Client Experience at the Center for Professional and Executive Development. I'm excited to have you all here with us today to learn more in this webinar. But before I hand it over to Dan, I've got just a couple of words about the Wisconsin School of Business Center for Professional and Executive Development, or CPED. CPED offers programs and certificates that give you the modern, relevant skills needed to advance your career. All of our programs offer interactive live learning sessions facilitated by instructors with practical business experience, and CPED also partners with organizations to provide customized professional development programs, coaching, and consulting. For more information on the Center for Professional and Executive Development, please visit our website at uwcped.org. So throughout the webinar today, if you have any questions that you would like to ask, you can go ahead and put those in either the chat box or using the Q&A button on the bottom of your screen. We'll pose questions that are submitted throughout the webinar, or we will have a Q&A at the end of today's webinar as well. I also want to mention that today's webinar is being recorded, and a link to the recording will be made available within the next few days. So with that, I would like to introduce Dan to you today. Dan is the owner of Topf Business Learning, an Iowa-based business acumen and leadership development company. With over 25 years of experience, Dan is passionate about helping people and businesses achieve dramatic performance improvement through business learning. He has a BA and MA degrees and has served on the faculty of the Drake University School of Education. He has also taught in the Tippie Executive MBA program at the University of Iowa. Dan is also an instructor for CPED's Finance and Accounting for Non-Financial Professionals program. So welcome, Dan, and thank you for being with us today.
Thank you, Brooke. And good morning, good afternoon, and good night, I guess, for some of us who are joining us at all hours. It's so interesting to see where everyone is calling in from or joining us from. If you didn't hear that instruction, we're dropping in where we're joining from in the chat. So please, if you haven't done so, just go ahead and add that. I am delighted to be here to speak to you about this wonderful and interesting, to me anyway, perspectives on what does it mean to learn about insurance accounting. They are only 5 factors. And so, wait a minute, I thought there was all kinds of accounting rules and so forth. But in fact, there really are only 5 factors for us to master as it relates to insurance company and insurance financial and business success. I would offer also that there is still a lot to learn. So what has been my experience is that indeed we have a long-term journey here to learn about the relationship of our business models, our product structures, our distribution strategies, and so forth, and how that relates to maybe some of the decision making all the way into your part of the organization. Nonetheless, I have a passion for business acumen and business learning, which is why I've made it my career. I am a CPT, a certified performance technologist, and I focus my expertise and my passions in my work in this area I call business learning. Business learning might include financial topics, it might include interpreting financial topics for you and your business, and it might even be a part of a learning journey for leader development inside of the insurance space and inside of your firm. So what I have prepared for you here is, in one way or the other, my insurance clients and learning participants, either through working with CPED or in the life insurance side, working with an organization called LIMRA and other kinds of experiences that I've had. These are some of the learning points that I've discovered that are most useful for my program participants. Now, am I going to be able to get to it in as much depth as I would in a 4-day course? Of course not. But I would like to share with you some of these high levels and maybe even pique your interest to learn more. My overall goals today is to introduce to you, first off, these 5 factors And these 5 factors, I would encourage you to jot them down on whatever notepad you're using to keep track of things today. And that is to say, what is margin, asset management, cash, growth, and people? These are the factors that I'm going to be exploring today in the webinar. I want to also kind of show you the unique nature of insurance company business and financial performance. If you've spent any time in the industry, you realize that it's not at all like where you came from. So if you had worked at a manufacturer, you had worked at an engineering firm, you're a marketing professional and you worked at a couple of different companies and now you're working in financial services and insurance, you realize that it's a different animal. The culture is different. So the place, the feel, the vibe, if you will, is so much different. But also they're talking about these ratios. They're talking about priorities of different kinds of products. And do I even understand how we make money with all this? It just seems a little bit bewildering. So that's one of the things that I hope to give you at least a little bit of a pathway today. And that goes to the last thing, because I am an L&D professional primarily who happens to be in this space called finance and accounting, to help you see and learn this stuff. A lot of times you just learn what you don't know, and so you need to learn some more. Okay, so we'll give you some resources as follow on, and I may reference some resources as we go through the webinar today. Overall, my agenda, after a little bit of a welcome, is I'm going to start right off with the Business Awareness Challenge. If you've been to any of my programs, this is what I always start with. It tends to activate your prior knowledge. I'll speak more about that. We'll go over the 5 factors in a little bit more depth, and then we'll take them one at a time and hopefully get everything accomplished in the next 50 minutes or so. This is a lot. I give you, it's a lot, even for the most experienced folks that have been in the industry for a while. And even if you come from maybe one of the more quant side of our business, like actuarial or underwriting, but nonetheless, hang with me. It's still going to be, I think, a good use of your time. So let's start off with the Business Awareness Challenge. My goal here as an instructor is to awaken your prior knowledge. So you probably know a thing or two about financial matters as it relates to insurance companies, and there might be other things you have no idea about. So let's just kind of ask yourself some questions. Here's how it works. Open up the chat window. I'm going to give you 4 questions in the Business Awareness Challenge, one at a time. Put your answers into the chat. You're going to do 2 things. One, you're going to see other people's answers, and then you're going to see your answers, and then you're going to see if you got it right or not, or you'll see the rest of us don't know anything either, and it's just fine. Okay? All right. So open up the chat window, and let's get going with our Business Awareness Challenge. Our first question is this: what are 3 universal financial statements for any insurance company? What would be 3 universal financial statements for any insurance company? Please put those into the chat, would you? Thank you, Gene. You get a gold star for being first. Keep going, you guys. And if you don't know, you don't have to play. All right. All right. Let's see. I'm seeing income statement, cash flow, and balance sheet. And that's the answer. Good job to those of you that had those 3 financial statements. Those are universal for any business. However, that might be where the commonality ends in many respects. I mean, that's the same statement, but it's going to look very different than, say, Oshkosh, the manufacturer, right? Okay, next question. This might be a guess. What proportion of the 2022 United States economy invested assets is held and managed by our industry? So of all the invested assets we have in our economy, How much is managed by those of us in the insurance industry? All right, I'm seeing 30%, 20%, 50%, 15. Good job, Wade. Got to get that decimal point in there. I like that. You and I would get along great. Yeah, got to have that. Uh, got to have that sense of precision. Well, if you said 31%, you got it right. So just contemplate that for a moment. What we do is vital to our economy. So that's number one. Number two, understanding this is a big deal. So if we understand how these financial flows all work and how we keep promises to customers and why we're so heavily regulated and so on, that's even better. And if we want real change in our economy, who's got the leverage? It's the people that own 30 to 35% of the economy as leverage into policymaking, into consumer behavior, and so on. We'll talk more about that when we talk about catastrophes and how we're dealing with climate change and so on. But nonetheless, we are big players. We hold a lot of the money. What is STAT? You may know what that is. Put your answer in chat. It stands for something. Actually, it doesn't stand for anything. It's actually a abbreviation. It's an abbreviation. Go ahead, put your answers in. I love it, Melissa. Yes, we have to get to the emergency room stat. Statutory accounting principles. Yes, indeed. Statutory accounting. There are different kinds of accounting rules and regs in terms of rules of the road or how we account for things. And in fact, even a health insurer or a property casualty insurer, business insurance, um, life and annuity companies all need to follow statutory accounting. The other thing, nobody else has to do it this way except insurance companies. We'll talk more about that. I think I have one more question. This one is easy to answer. True or false? An insurance company generally may not collect enough premium or deposits to pay the claims for the year. What would you say? That's true. If you're thinking true, it is indeed. So good job, everyone that said true. Yeah, that was something when I was new to all of this. I thought, oh, if they collect $1 in premium, that should cover whatever payouts they have to do this period. And in fact, it's sometimes it's not even close to being enough. And that's okay. That's on purpose. So we'll explore that as well. All of this leads to, are we understanding then what are all these facts and figures? What are these financial statements telling us? In other words, what is the score? Now, if you think about it, if I look at this score sheet, do we have a way to interpret how the game turned out? Now, if you look closely at this, I think a few of our colleagues, I'm going to assume that our colleagues on the call from India will recognize this score sheet and probably have an emotional reaction to it. It is a cricket score sheet. Now, those of us in the West, we have no idea about cricket. It's confusing. We think it's kind of like baseball, but actually, no, they're running back and forth and the bat's different and there's the stadium is round, or I have no idea what it is. Yeah, right. And if you look at how all of these data, it looks bewildering, which a lot of times our financial statements are presented in the same way. Now, those of us in the West, and particularly our Americans, how was this game? Now, look at this. Well, we hate the Cubs, so we're going to have a visceral reaction to these numbers, and we don't care. Shoot, it was 2016. What have they done lately? And oh, yeah, yeah, all this kind of thing because we recognize it as a baseball box score. All right. And in fact, What's so interesting about this is that to many of us, when we look at a financial report or a quarterly all hands meeting about how we're doing, or we're looking at these financial reports from the our regulators, or we're doing our our capital adequacy, or shoot, we're going to our best rating, our best report. It looks like this. That's the reaction we get. It's just bewildering. So we have to find a way to become a little bit more familiar, but also know how the game is played, because we need to know how it's scored so that otherwise we can't win. We need to know the rules and how they affect the game. So that goes to how the regulator looks at us. How do our investors look at us? How do our policy owners view us? And potentially, how do our members see us if we are a fraternal organization? So we need to have an understanding of the strategy and the plan. And that's what I spend my time doing. We have to be fluent so that our brain is free to start thinking about possibilities and what matters and what doesn't. And so when we make these decisions, we know we're optimizing to drive a result. And if we don't know what the strategy is for our growth for our company, whether it's product, policy, uh, assets under management, uh, market share, et cetera, we don't know the game plan, we can't hit any of those targets. So let's start off with something I hit at before, the types of accounting. There are two big types of accounting that we learn about in the fundamentals courses that I teach, and in one case, the finance and accounting for non-financial, is that we have external accounting and internal accounting. External, we call that financial. So that has external meaning it's prepared for someone outside of the company, all right? Whereas internal would be this is for our use only, and a lot of times it's proprietary or confidential. We use financial accounting to meet external standards, like for globally accepted accounting principles or statutory reporting. I'm going to talk more about these two differences. And for audits, for other regulatory, for ratings, we submit statutory stuff to BEST to get our ratings. Maybe we're selling a piece of business or book of business, we would say in our industry. So we have to come up with some sort of value of that. Most of this financial accounting is looking back in time. Whereas management accounting, that's for internal, that's your budgets, your targets. You work in the IT help desk, and we've got 16 associates plus an outsource, and we have a budget for that. And we're going to manage that going forward. And we're going to see how we're doing relative to budget as the year progresses or as the period progresses. So it's important to notice which kind of accounting are we talking about here. We're going to look at our externals. We're preparing for different audiences. Each has its own sets of biases and controls, rules of the road. Sometimes the numbers have assumptions behind them, and it might be just driven by the different kinds of accounting. Regardless, one thing that all of these is that adherence to facts. So whether you're writing an invoice, testifying at trial, or preparing financial statements, we must be factual. And so what does that mean? Within that requirement, we still have to have rules of the road for how we approximate things. We prepare things in good faith. We acknowledge there might be different kinds of bias. There's a bias or a slant to when you're talking to shareholders. It's just embedded in it because it has a certain kind of gap feel. And there is a bias when you're doing statutory, which is conservative, which is more cash-based, which might be more protection for policy owners. And it might have a little bit less risk-taking in it. So there's different biases, not to mention that when you put together a budget, some folks are sandbagging or they're asking for the world and settling for the stars. You got all those kinds of games that sometimes can be played. But what's critical for all of us in business acumen is to understand the assumptions, estimates, and facts that these things are based on. What are the relevant assumptions, the relevant estimates, the relevant facts? And if you don't understand them, we've got to ask and we've got to learn them. And that's okay. It isn't putting someone out, or it isn't being insubordinate. It's like, I need to understand how we arrived at these FTEs for this particular service model. How do we arrive at that? What does that mean? And how much does each one cost? And what are those assumptions, so that I can understand it and I can then do something with it. If you don't, things get very arbitrary and confusing. We have to also be clear about what numbers am I looking at? Are these projections, or are these backward looking? So is this a management accounting, or is it financial accounting? And what is also critical for anyone, whether you're noob or you're advanced, is that none of this means anything until you start to compare it. And then you can judge whether the comparison is in fact legit. Okay. Well, that's expensive compared to what? Well, compared to the benchmark. Well, then if we all go to the benchmark, then it's all mediocre. We want to be excellent. So why are we comparing to the mediocre average? We should be benchmark plus. I don't know. Let's talk about the appropriateness of some of our comparisons. Okay, so that's by way of introduction. I did mention this thing called statutory accounting, and I'm sure that you've heard a little bit about it, or maybe even a lot about it over your time at your employer. But I find, just really high level, it's really useful to kind of think about the two major kinds of accounting rule sets or regimes that we are dealing with in our industry. Generally accepted accounting principles, again, for external audiences, and statutory accounting, again, for a different kind of external audience. So then I ask, well, then who is that? Well, investors want GAAP. It's referred to as GAAP, all right? In all businesses. So this is all companies that want investors will use generally accepted accounting principles, and they do business in dollars. They will use generally accepted accounting principles, and they're probably traded here in the American stock markets. For those that are outside of the US, there's another regime, but a lot of times they'll produce financial statements in both systems. It's called IFRS and GAAP in that regard. And then in the US, we have statutory, so we'll call it STAT or sometimes SAP, but then that confuses us with that software company. So then they'll just call it STAT. And that's for your state regulators, the National Association of Insurance Commissioners, your rating agency like BEST, and others. And this is for insurance companies only, statutory accounting. Must be followed by everybody that's in the insurance businesses. What the basis is that generally accepted accounting principles match the revenues and expenses for the period as an ongoing concern. So they're going to assume that you're going to stay in business for the foreseeable future. So that's one bias. So that means matching up these expenses. Like if we have a whole bunch of expenses, we might only incur them in our financial statement over the life of the contract. So we'll just do a little bit at a time. Manufacturers do this with depreciation. They will spend the money to buy a capital asset, but they'll only expense parts of it over the life of that asset, of that machine. So that's a GAAP thing. So for example, if you hear them talking about deferred acquisition cost, then they're talking about it, that's a GAAP thing. So that's your tell, okay? Because they're they're spreading these acquisition costs over time. Whereas with statutory, must be followed by all insurance companies for appropriate ratings. Remember that it is primarily for policyholder protection, and its focuses on solvency and claims paying ability. So not about matching so much. It's just like at any moment, can you pay your claims? Because you have obligations, you've made promises, you got to be able to pay your claims. And so you'll see these terms like non-admitted assets, risk-based capital, AVR, IMR, that's kinds of things in some of these statements. And that's a tell that it's statutory. The assumption is like, would you have the money you need to pay all the claims? And then you would say, well, we have capital adequacy ratio of 4. And that's essentially saying, in a very simplistic way, oh, capital adequacy, you could pay all of your claims 4 times over because you have enough assets on the balance sheet. Yeah. Now, are you liquid enough to do that? That's not really what that's talking about. but it's just about, do you have the strong enough balance sheet to meet your obligations for policyholder protection? Okay. Oh, so there we go. Whew. So why do these scorekeeping methods matter? As I mentioned, in order to play the game, you got to know how you keep score. And you know how to keep score, you know where you are in the game and what sort of changes you might make as you're playing the game. You're using different kinds of strategies and so forth. All of that stuff leads up to this notion I call and refer to as business acumen. When we have business acumen, we understand how our business makes money, and in particular, our part of the business. So if I'm writing business insurance, that has a different profit model than, say, I'm writing renter insurance or consumer auto, for example. So I need to act to improve the money making process. And so understanding how we compete, how we win, how we earn premiums, how we earn profits, how we keep promises, all matters. And so this is really my passion. All right, so what are these 5 factors? So I hit highlights of these in the opener. So let's go through some of these in more depth. The first one is that there has to be a margin. If you make a margin, that is a difference between the revenue you collect minus all of your costs, leave you some profits. And if you're making a profit or a margin, you're in business. If you're not making a profit in any given period, you might still be in business, but it's not sustainable, of course. Okay. So we're going to talk a little bit about margins. Now, within the insurance world, you have loads of margins that are expressed as ratios, which is a relationship between the revenue in property casualty, it would be premium, the ratio of premium to an expense or a total number of expenses, different types of expenses like combined ratio, operating ratio, and so forth. So we'll explore those in some depth as we dig into these. The next factor is asset management. So there are assets on the balance sheet that have obligations against them. We'll collect premium and deposits, we'll invest them, and then use them to pay future claims. And so that is a key driver of our performance because oftentimes we are, as a company, earning a spread on those assets. Those assets grow. Some of that goes out in payout. Let's say it's a 401k account on a life and annuity company. Well, that gain will go to the policy owner, but the company may earn a spread or may earn a fee in order to manage those assets. So the more, and it's usually expressed as a percentage of the assets and so forth. So asset management is absolutely key. Cash and cash flow, sometimes called liquidity, your ability to take cash in faster than it goes out so you can meet your obligations for payouts, whether that's a claim, whether that's a death benefit, whether that's a retirement check from your 401k, whether that's all of these kinds of things that we are able to do. Growth, the business needs growth. If you're not growing, you're dying. And so companies are always looking for growth. Insurance companies are no exception. And then, of course, it's all about people. You would hear that at any company, but especially because what we do is so invisible. We're out making promises to our policy owners and our plan participants and our benefit sponsors. We're making promises that we're going to be there when you have a fender bender and need your car fixed, if you have a wildfire and your house is destroyed. We're going to be there and help you. We're going to pay out the claim. We're going to get you back on your feet. We're going to pay for your health care, right? We're going to do the thing. And it's all about keeping promises. You're going to do this exchange, and we have a sacred obligation in many respects. So let's go into each one of these in some detail. First one I want to dig into is this thing called margin. Margin simply means revenue minus costs equals profits. So we'll talk about that ratio. Margin is key, even if you're a nonprofit, even if you're a mutual or a fraternal organization. where you're purpose driven. Oh my goodness. Here's one of my favorite business leaders, woman named Sister Irene Krauss. She was known around the business circles as the CEO nun. She ran health organizations, hospitals, health clinics, hospital systems, but she was really one of the most vocal when it came to strong fiscal management. Because many times within her hospital, it's run by the Sisters of Charity. And you'd think, oh, well, we don't have to make money because we're a nonprofit and we have this charity mission. And they're like, well, no, we can't survive that way, losing money every period. So we have to keep our eye on profitability, even though, because whatever this turns out, we need margin or we cannot fulfill our mission. So no margin, no mission comes from our friend, Sister Irene Krauss. So let's talk a little bit about this one financial statement that we said was key. This is the profit and loss, also called the income statement. On a statutory basis, it can be called the summary of operations. And in fact, some of the terms might be different. But nonetheless, it shows us, first off, what are all the revenues? So a property and casualty, primarily their revenues are premiums, and it's earned. Premium earned versus premium written. Huh, what's the difference? Well, here's the way you think about it. Let's say I buy 6 months of insurance for my car and I paid for it today, 6 months worth. Well, you're going to earn that premium over the life of the 6 months. Even though you wrote the business, you have the cash because I wrote you the check to pay my premium, but you earn it over the several months. Okay? So that's the way to think about that. Losses and expenses. And also keep in mind that these losses that you pay out are may not be related to the premiums that we just earned. In other words, a different customer paid their premium and another customer has a loss that needs a payout. Operating expenses, you have this thing called underwriting gain, which is then our first type of earnings or profitability or margin, is to say, well, how are we doing relative to this? And this would be our loss ratio right here. Okay. And so we say, ooh, okay, it's a little over 100%. We lost a little bit more than our total premium. So our loss ratio would be a little bit north of 100. But then we get some investment income. That is the gain that we have on the assets that the company manages for itself. So you might be getting some spread or some other gains of other investments and other capital gains and so forth. And so now we've got this net profit before income, dividends and taxes, and then we have our total net income. Okay? So this is fairly standard and representative of our industry. But then here comes slightly different for our friends in the life insurance business. Notice that their total revenue is driven really by three types of revenue. The premiums, just like property and casualty, but also the investment income's up here. And then fees. Okay. So generally thinking about that, what proportion is what, and where's the revenue coming from in order to generate total revenue? Okay. And of course, payouts and other reserving and those kinds of things are all expressed here in the profit and loss statement. And you'd ultimately get to a net profit. Okay. So let's just compare these. Let's go back and say, all right, this is property and casualty. They put investment income down here, whereas the income statement for a life company, it's up here. It can get confusing. And then our financial statement might have different words on it. Oh my goodness. But you know what? Once you become a master of this structure, how the profit and loss is structured, like what's first, what comes in the middle, what comes at the end, and how we refer to it, the less the words matter. You can just look at, oh, top line. Oh, these are operating and fixed expenses. Okay, this is my net. And generally, for example, you realize quite quickly that taxes is always toward the bottom, right? Interest charges, like you're paying interest on any debt. Oh yeah, that's toward the bottom. Okay. And you really begin to master this the more you're exposed to it. But once you begin to realize, oh, well, wait a minute, we only had one period in my examples. So now we start to compare. We can compare in one period. So if we do what's called a vertical analysis, we'll use all of our ratios, our loss ratio, our combined ratio, so forth. Those are horizontal. I'm sorry, they're vertical. Excuse me. Those are vertical. They're going up and down within the same period. But another thing that you can do when you compare is you can compare over time. So is our loss ratio getting better? Is revenue growing? That's your horizontal analysis, period to period. Okay. But nothing means anything until you compare it. So we can compare it over time. We can compare it to the expectations of the rating agency. We can compare it to our own internal benchmarks and return on capital. We can compare to the overall growth of the economy. And there's all kinds of things that we can compare to. So when we're talking about margins, we're really using these key ratios. Loss ratio is what proportion of our premium this period is paid out in losses. Expenses, what proportion of our premium this period is used to pay expenses. Combined ratio combines those two. Investment ratio is what proportion of total premium is the investment we've gained, or investment income. And the operating ratio is all of it. Okay. And we can say, well, if it's a little bit too high or too low, we begin to like target it because we have different types of ratios that we see how they roll up into one performance report. All well and good, Dan, but what do I do with it? Here, my challenge to all of you is to find out or to enhance your answer to these kinds of questions for your own company. What are we making the most money on? If we write new business, how long does it take for that piece of business to be profitable? So if we insure a car, 3 months, 6 months, does it have to be on the books for 5 years before that customer is profitable? That will drive different kinds of customer retention strategies. You believe it. If we sell a renter's insurance, do we make any money on that? Or what are the risks in renter insurance compared to, I don't know, farm insurance? Some of us write farm, some of us don't, for different types of risk profiles. What do we do the most of? I mean, what's the biggest proportion of what we do? And is that the most profitable, or is that just an opportunity to provide a customer an add-on sale, an add-on relationship that actually is a lot more profitable, even though the dollar amounts and the premiums and so forth are less? Okay, so understanding that would be key. Are our costs growing? Well, probably. But are they growing faster than our revenues, whether that's premium, fees, or investment income? And then, gosh, if we do more business, what costs will go up? Now, in the long term, all costs seem to be variable, but your accountants will treat certain costs, like your operating expenses, as fixed costs, and certain servicing kinds of costs as variable, because the more transactions we do, the more costs there are. Or we may even have variable revenue related to fees. So if we do more transactions and there's a fee for each transaction, well, then we can drive revenue up. Okay. Again, understanding the relationship of all these kinds of things is so key. So jot these things down in your notes. Get them all in there. It's like, gosh, do I even know the answers to these kinds of things? It has direct impact on whether you're in service, marketing, IT, operations, etc. It has direct application. I have yet to find a leader within an insurance company that couldn't benefit from a better understanding of these variables. What you can also do as leaders is that, unfortunately, it falls upon us to explain what's going on to our teams. And sometimes our teams have maybe just as much or even less business and financial acumen as I do. So what's a way to make it compelling? And that is what I call the value of one. So if we improve our combined ratio by 1 percentage point, what value is that? And so we're doing things to improve our losses, but we're also doing things to be more cost effective with our expenses. So, gee, what can we do? Because if we move that one full percentage point, it would have a huge impact. So one of my clients did the math. So they had a $60 million targeted earned premium target. And if they would improve this combined ratio by 1 point, it was worth 60 million in new premium. Okay. So now they're getting to understand what, oh, so for every one of these, it's worth this much. Okay. You can also talk to people about simplified driving models. Like, well, if we're going to improve our income from underwriting, well, and our income from investment management, we need to see these, proportions. And, combined ratio is, that's okay. And then our investment ratio, that means we could lose money on our actually running in our insureds, but we make money on our investments. And overall, we have a strong operating ratio. And so, oh, okay, that's how that works. Or you might say, well, what's driving our combined ratio then? Well, it's our payouts for losses and the expenses to do the payouts. Okay. And or to even have the insurance. So the commissions and things are inside of this expense ratio, our overheads and taxes and fees and so forth, but also costs associated with settling a claim. So if you're our friends in property and casualty, you have adjusters and auto adjudication, right? So we have these kinds of AI models that will drive down these costs and making sure that we're writing the business correctly so that we have appropriate premium to match the needs of the risks that we are faced with. So all of these things are worth pursuing. Just becoming a little bit more fluent, I think, for all of us in our insurance industry to be leaders in our field. Whew. All right. Wow. That was margin. Let's talk a little bit about asset management. I don't have as many slides for this. That was the one that had the most slides. So let's talk about asset management. Now, assets are represented for us on a company balance sheet. I have this camera icon on here because a balance sheet is a moment in time. It's a snapshot. Whereas the profit and loss is a bit more like a movie. What happened for the entire period, the quarter, the year. Whereas this, we take a moment in time, let's say the close of business at the end of the fiscal year, and we prepare our financial statements. Okay? What you'll notice, for example, this A area, what are all of these things? Most of the assets in a balance sheet for an insurer are in investments, in this case, securities and cash. That's where most of the money is. They're holding this stuff and investing this stuff for future payouts. These two numbers, these are receivables. A receivable is an unpaid or uncollected payment from whether it's from a customer or from anyone else who owes the company money. So in this case, they typically have receivables from agents and other reinsurers for collections and reimbursements. And here are policy acquisition costs. Under GAAP accounting, these expenses are deferred and spread out over the life of the contract. So, oh, you sold a annual policy, we'll split that out and expense it over 12 months. If you are doing it under statutory, you have all of the expenses are happening in the period in which they happened. They're all entered in that regard. Let's see, what else have I got here? DEF, this section here, this is talking about, money that we owe but are reserved. So we owe these claims, we owe these premiums that are unearned, and we have other kinds of things that we owe because it's a liability. And they're obligated to pay them. And this is what really the regulator is really looking at to say, okay, here's what you have, this is what you own, and this is who you owe, and have you capital adequacy to meet those obligations. And then finally, G here, this equity, also called surplus on a statutory account, is the net. So in other words, assets minus liabilities equals total equity. Another way to think of it is the balance sheet balances. So assets equal total equity plus total liabilities. Okay. And so then they balance. So it's 38,361, and it's the same on both sides. That's called the accounting formula if you really want to nerd out. Okay. And so this looks very different from, say, a manufacturing company or a coffee shop or a consulting firm, or this looks very different, right? Or even a bank. And that is material. In other words, that matters. So it's important for us to really begin to appreciate, where the money is and how the business meets its obligations and keeps promises to policy owners and other stakeholders. One of the ways in which you're evaluated and compared is with your return on assets and your return on surplus. These returns answer the question, are we making enough profits? Okay. Are we sustainable in that sense? Are we going to be able to meet our obligations now and into the future? These returns are not investment gain returns. Like, let's say we put money in a fund and then over time we have a personal rate of return in this fund. That's not what this is talking about. This is talking about, okay, off the P&L, we showed that we had made 600 and we had over 3 billion in assets under management. So we made 600 over 3 billion. What's that return for this period? Okay. Same thing about equity. Oh, we made 600 and our equity was 3,000. What's that ratio? What's that percentage? And how has that been done over time? Okay. So these two ratios are critical for relationship between the balance sheet and the statement and the profit and loss statement. Only a couple more to go. Cash flow. Some say cash is profit is an opinion and cash is fact. I tend to believe that, and at least in terms of what we're able to accomplish. We have to be liquid. It's always a priority. And the idea in any life, property casualty, et cetera, company is to make sure the cash is flowing in faster than it flows out. We need to have the appropriate amount of liquidity. But unfortunately, when we are liquid, when we have cash, that and we keep it in a bank, let's say, it has the lowest return. We need to put it to use, which sometimes calls for it to be tied up over time. Like we buy a building with it, or we invest in real estate, or we invest in equities, or we do other kinds of financial instruments, bonds, let's say, and they have requirements. It's like, well, gee, if I can, how do I convert that bond into something liquid so I can pay a claim with it? So indeed, the cash in this flow is so critical, and these decisions around what policies to offer and how to reserve for it, and is it something that we can do so we can keep the customers happy when we have to do our payouts and so forth. So cash in the insurer is absolutely critical. Here are some of the drivers of these, particularly for property and casualty. These things like renewals, commissions, these are all operating cash flows, meaning operating the business. But we'd also have the cash flows, like I mentioned, like the investment cash flows, like this, particularly if we're buying equities or investments, so we can earn gain or spreads. And we might have some financing cash flows, like we might borrow or issue different types of bonds in order to raise money, and notes and things to raise money so that we can fund our growth. And then by comparison, you'll notice that in a life and annuity company, that persistency is key because it takes a lot longer for you to be profitable. Some life and annuity contracts, it takes 5 years for something to turn profitable on average. And so you got to retain that business. Yeah. So all driven by some of these key factors. So as you reflect on these three factors so far, consider what role you play, what key decisions you live. Are you just in the expense side of things, or are you driving customer retention? Because if we can retain the business, we can keep the customer, we get a chance to turn it profitable. If we can give a great client experience, customer experience, they will stay with us. They will raise our profile and help us get new business. If you understand those goals, I think you're in for real success. And in our final few minutes, let's talk about growth. Growth has to do with a lot of things. And the fact that you could think, well, maybe it's just top line, but whatever it is, if we're not growing, we're dying, according to, you know, very well-known insurance expert, Lou Holtz. He was really confident in his ability to continue to learn and to get better. And that's why he was in the job that he was in, right? So in fact, we have to grow. So we can grow top line, like I mentioned. We can grow the total assets under our management. We can grow profitability over time, but also consider some of these intangibles, like we're innovating, we're getting smarter. So we're growing our capability in our business. We are offering new solutions. We have new distribution models. We have new client portfolios. We have new. And so there's continuously keep that in mind when you're thinking about what do we mean with growth. And then our final is it's all about people. Again, a fantastic insurance poet, Maya Angelou. People will forget what you said. People will forget what you did, but people will never forget how you made them feel. And if any of you are on the payout side of our industry, you know what I'm talking about. When you hand them that check, when they have experienced a catastrophe, when you are able to help them protect their wealth as they go through transition, when they've lost a spouse or they've lost a family member and they are the beneficiary, when you're able to go from help someone go from being a saver to going from saving to withdrawing for retirement, and maybe they can hit some of their goals. It's all about, that's where the reward comes from in our industry. So that means we have to have great skilled people. We have to have great tools and processes. We've got to have great customers to help us innovate and create the value into the future. And when I talk about value in the future, this is what I'm referring to, is that, sure, we have a great balance sheet, but then what are we doing to drive profitability going forward? This is valuation. It's like, would I buy our stock? Would I buy this contract? We buy things for their future value to us. And the same is true in insurance. So we have to think about the value we create now and in the future. Quick example of this. Recently, Protective, an insurance company based out of Ohio, publicly traded. They had a balance sheet value of $3.7 billion, but they were trading a total market cap of about 4.2. So that tells me that if I take 4.2 minus 3.7 in tangible equity or surplus on their balance sheet, that they have, the marketplace is valuing all of this future focused stuff at about $500 million to get the total value of the firm, right? If you were to buy all the outstanding shares that day when I did this, got these numbers, you'd have gotten a bargain, because here comes Daiichi Life. They came in and made an offer to all shareholders to take the company and acquire it. And they're offering $5.7 billion. It's the same balance sheet, but they saw $1.5 billion more value than the stockholders did. Well, what do they see? Well, they see things like their expected growth expectations. They put these highlights in the press release. They see they have a great business model. They get access to new markets, and they got a strong management team. They got a wonderful business platform, and subsequently, they know how to do acquisitions and integrations. So as you think about that, that's creating value going forward, whether you are considered as an acquisition target or if you're considering about doing right by your stakeholders, whether that's your policy owners, whether that's your shareholders, that's your customers, etc. So as you think about that is all related to people. All right, let's summarize. Let's summarize. What am I talking about today? Let me hit some of the highlights. Insurers make money through operational effectiveness, efficiency, and asset management. Understanding that driver, those drivers based on what type of insurance company you are is key. I mentioned this customer retention is key. You do not want churn. You do not want customers churning every few months. We want to keep them and we need to keep them on the books. That's called persistency. Because when we keep them on the books, whatever they are buying from us can turn profitable and we have the opportunity to sell them and provide more for them. So persistency and customer retention is critical. And by the way, that is also driven by the actual customer experience. Measure of efficiency and effectiveness is the combined ratio. The measure of profitability is the operating ratio. And all these ratios must be considered in the business context. In other words, how we make money. So we talk about operating and combined, but also return on the returns on return on assets, return on equities. So things that make a difference, as I've hinted at, the lines of business, how we distribute our value in our customer. I said, are we just insurance? Are we a niche player or are we multi-line? Are we focused in on just business insurance or are we trying to do business and consumer? Are we having all of these alliances and allegiances with banks, with life companies? Are we really writing the risk? Are we in states where we can make money? All of these things are part of that story that is so critical to how we really work. So we have some time now to take some questions and perhaps some answers. A couple of things that I want to point out to you. Brooke has put these slides. So one question you might have is, can I get the slides? And of course you can. So that document, that PDF is there in the chat. And I'm happy to take your questions. So put any follow-up question that you had to all of this jazz into the chat, and I'm happy to speak to it. I'll give you a moment to type.
Thank you, Dan. And while everyone is thinking about their questions, and before we do the couple of questions for Q&A, I do just want to let everyone know that CPED is ready to help you and your team members further develop business acumen through both our professional development programs as well as custom solutions tailored specifically to your organization. We have a team of solutions advisors that are ready to help you out, discover what your organization needs. You can find our contact information again on our website at uwcped.org, and as well as Jeremiah DeGullen. You can email him at jeremiah.degullen@uwcped.org as well. So as we get any questions in, just keep in mind that we're here to help you discover any sort of way that we can help tailor our programming to your needs. So I'm going to jump into probably maybe a related question here of how can a professional who's been in the industry a while raise their business acumen?
Great question, Brooke. I think about this in a couple of different ways. One is a personal take an interest, right? So if you take an interest in the industry, there's lots of resources available. So for example, look for your trade associations, whether you're in property and casualty, life and annuity, health insurance, go to your trade groups. They offer lots of credentialing of different types. I think that's really super valuable. Get yourself a mentor, particularly somebody that's on the quant side of things. So maybe you've got an internal partner that's your finance person that comes from the finance department. So they're going to help you understand your own budgets and budgeting, for example, or chargebacks and kind of allocations of different expenses and stuff. If that's what you're interested in, go talk, make a friend over there. You might also make a friend in the If you're a publicly traded company, go over to investor relations and make a friend and find a mentor in that space, because they're talking to external audiences and trying to reassure external audiences about the performance of your stock price. And of course, we have loads and loads of programming within some of our client arrangements, and particularly with CPED. And I know that we do internal uh, programs, custom programs for our insurance clients. So those are a couple of quick things.
So I know we are at time, but to wrap us up, Dan,
Let's see,
does
Wade
admin
was asking a
expense,
question there.
yep,
Yeah,
does admin expense margins vary across insurance companies?
it sure does. It sure does. And again, if I had more time, I could give you some examples. You have administrative expense, but then you'll see that the proportions are different. And yet maybe something with high administrative expense has a lower loss ratio because they're spending their money on writing really good business. And so the payouts are less, and getting the pricing right and getting everything, they got a really super expertise. Or what do you like, for example, Hartford does this, where they have experts in fire safety, expertise for businesses in particular. And so then you have these mitigation factors that they consult their customers with to allow them to have less risk. Right? So indeed, administrative margins vary. That's called your expense ratios. So to have a low one or a high one may not mean good or bad. It's got to be done compared in the context. So
Excellent. Well, thank you again
um,
for your time today, Dan.
yeah. And
To all of
one quick thing, Brooke, that I thought of this morning, and I want to steer everybody to the unexplainable podcast. Unexplainable podcast. Unexplainable. It's by Vox, VOX. And their podcast recently talked about property and casualty insurance as it relates to climate change and as it relates to catastrophes, and how much pressure this is putting on our industry. So if you live in that space and you're hearing about it, about are we even viable? Do we understand? I think it's fascinating because we in the property casualty industry can influence even the laggards and the others who maybe aren't adapting to climate change fast enough, but we can through how we insure risk. So I want you to listen to that. I think it's a really good next step. Vox,
us.
VOX, has a wonderful podcast called Unexplainable.
Great recommendation. Thank you, Dan. And thank you to our attendees, and hope you all have a wonderful rest of your day. And remember to check us out at uwcped.org. Thank you all again, and have a wonderful day.
My pleasure.